Okay, there we go. So good evening, everyone. Welcome to tonight's class. Apologies for the change in time and the technical challenges that we had, but we're all set and ready to go now. The idea here is to just present some introductory option strategies, okay? It's not going to be a super in-depth class. There's not going to be any calculations or anything like that, so don't worry. But we will be starting with the basics and we're going to build on them. And then as we go through these sessions in the future, we'll do a deeper dive into each individual strategy. But for now, it's just going to be a brief introduction and to give you some ideas as to sort of what is possible and how you can use options for more than just what you may have been using them for so far. Okay. So the first things first, have to go through the regular disclosure. I'm not a licensed financial advisor anymore. I was years ago, but that's a past life now. So anything I tell you here is obviously not financial advice. And I'm always going to caution you that whatever you do, make sure you understand the risks and manage them accordingly. Okay. So, if you follow me on Twitter, great, thank you. If you don't, it's at the STRATalorian. And of course, as Dame says, shout out to the pack. All right, so first things first, most of you have already been trading options, but I can't go through what I want to go through without doing a quick review of the basics. So you have to know and understand how options work. If you don't, you are going to get yourself into a world of trouble, okay? When it comes to, buying stock, the risks are fairly limited. When you get into the world of options, especially when you start selling options, so whether that's part of a spread or whether that's part of, your strategy for, say, income, you have to know and understand the risks, okay? After stocks, in terms of risk, you have options, and then after that, you have futures, okay? But keep in mind that with options, there is a lot of potential. You've seen how the pack has been eating using options, but there's also a lot of risk when you're on the other side of the equation, okay? When you're selling options, you now become the casino, you become the house, which means that the risk falls on you. Now, how do they manage their risks? They manage their risks by knowing that statistically over thousands, hundreds of thousands, millions of transactions, they are going to come out ahead, okay? We don't have seemingly unlimited funds the way institutions do, okay? So anything that we do, it's not like we can just, dip into our pool of billions of dollars and, offset one transaction with another. It doesn't work that way for the retail trader. So anything you do, please, 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 I beg you, don't do anything that can get yourself into more trouble than maybe you're anticipating you can get into, okay? And I'll talk about these risks as we go through them. So what is an option? An option is basically just a contract between a buyer. So if you're long an option, whether it's a call or a put, you are the buyer, you are considered to be long, okay? And the seller would be short. So even though you might buy a put option like we did, with SPY, SPX over the last few days, you are still long that put option. Okay, so when we're referring to long and short with options, we're referring to what side of the transaction you are on. Okay, so if you are long, you have the right, but not the obligation to buy or to sell a specified amount of the underlying asset at a specific price before a specific time. Okay. It's very important to understand, like for example, if you are long a call and you are short a put, both are bullish. Okay, and we'll talk about that here in just a sec. in order to know what your contract, so most of us are trading stock options, so it would be based on 100 shares. So that would be your trading unit. When you get into more complicated things like futures, it could be ounces, barrels, bushels, dollars, etc. Okay, so the strike price, we know it's the price at which the underlying asset can be bought or sold in the future. You already know this in advance. Okay. One sort of point that I'll make is that there are two different types of expiries. Okay, so for us here in North America, the day the options expire would be the third Friday of the month for monthly options. If you're trading weekly options, you've got the weekly expiries. If you're trading SPY, SPX, it's pretty much almost daily at this point. Right? So just understand that the more time you buy, the higher probability you have of success. But at the same time, it's going to cost you more money, right? So you get what you pay for, especially when it comes to options. In Europe, they have what are called European style options, where you can only be exercised on that particular day. So on the date of expiry. Here in North America, you can be exercised anytime when you sell an option. Okay, and we'll talk about that down the road. So trading unit, I've already spoken about. LEAPS, basically, it's a fancy name for long-term options, right? So long-term equity anticipation securities, or LEAPS. Calls gives you the right to buy the underlying. Puts gives you the right to sell the underlying. An opening transaction, when a new position is opened, it will increase open interest by 1. When that transaction is closed, it will decrease open interest by 1. Here in the pack, we talk about how many people are at the party, right? So when we're looking at open interest, we want to make sure that there is sufficient open interest to at least, open interest and volume to offset our transaction should we need to exit. If there's 10,000 open interest, then it's very likely to be a liquid option. If there's 10 and you're the only person who's holding that option, then you're going to have to deal with the market maker, and you might have to pay more to even exit your position, right? So just keep that in mind. We always want to look for liquidity. So out of the money, basically with the strike price for calls, an out of the money option would be anything that is above the current market price, right? So if SPY is at 390, anything above 390 would be out of the money for calls. For puts, anything below 390 would be out of the money. At the money is basically just the closest strike. In the money is where you now have what's called intrinsic value. So for SPY, if you had a 385 call and the price is 390, then you are in the money. Okay. Most brokerages will actually show the difference between the in the money and out of the money options based on shading of the background, right? So I think with TOS, it might be like purple or something. Bar chart does it. A whole bunch of different platforms will do the same thing. The options price is made up of intrinsic and extrinsic value. This is very important to note, okay? If an option has intrinsic value, that is real value. So if XYZ stock is trading at 100 and the call on the stock has a strike price of 90, this option would have $10 of real or actual value. Okay. When we trade options, right, especially when we're going for like the thou-wows, when we're doing the analysis, we want to try and get our option to be in the money by the time we're ready to exit. And when we talk about the different variables of the options pricing model, it'll make a little bit more sense as to why. Okay. Extrinsic value is time value. So anything that is at the money or out of the money, it's just strictly time value. This is important when we talk about selling options, okay? Assignment is when the holder exercises an option. If you've been assigned in the past, you know what this is all about. If you haven't, you're in for a surprise, okay? Especially when you start getting into spreads, right? Or if you're, selling puts or something like that, you can end up being assigned before expiration, right? So that's one of the unique features of North American options compared to European style options. And then the break-even point is basically where you earn no profit. And if you want more details, you can go to optionstrading.org, and that glossary there is really, really good. Okay. So now let's talk a little bit about the Greeks. Let me just make this a little bit smaller so that you can see it. It is absolutely imperative that you understand the options Greeks. Now, I don't mean that, you need to be able to do the calculations based on the Black-Scholes options pricing model, but you have to understand how, what I like to call the four horsemen of the options Greeks work, okay? So you have delta. Delta is the rate of change between the options price and a $1 change in the underlying. What does that mean? Basically, how much will my options price or my contract, how much will my contract go up or down if the stock goes up or down? That's really all delta is. It's the rate of change between the price of the options contract that I bought and the underlying security. Some will also use delta as the probability that the option will expire in the money. Okay, I personally don't use this. Some people do. That's fine. It is, it's valid. It's accepted in the industry. But if an option, say, for example, has a delta of 20, it has a 20% chance of expiring in the money. Now, of course, there are other factors, other variables that tie into that probability. We're not going to get into that now, or probably ever, because it's super in-depth. But just know what delta is. How much will my contract change? That's all you need to know. Theta or theta, depending on where you are in the world, is time decay. This represents the rate of change between the price and time. So if it has a theta of 50 cents, that option would lose 50 cents of value every day. This could be your friend or it can be your enemy, right? So if you buy out of the money calls on something that's expiring on Friday and it's Tuesday, you're going to see time decay start to work against you if the price doesn't move, right? And when you really start to see the impact of time decay is on 0 days, right? Especially if you've ever traded something like Amazon or Tesla or Nvidia, where by the end of the day, once you get to around lunchtime, you can actually see the market makers dropping the bid on those to basically account for that time decay. So if you are long options, time decay is working against you. If you are short options, time decay works in your favor. So oftentimes you'll hear me talk in the chat or in the live Zoom room about, how people with larger portfolios just sell premium. They do that because every moment that passes, more money basically appears in their account, right? Simplification. But when you're selling premium, it's carrying additional risks. You have to understand that, of course, and you should accept those risks because, I've seen a buddy of mine who, will trade like Tesla, for example. He'll sell Tesla calls and, Tesla will go up and he'll be like, yeah, I'm down, $1.6 million today based on these options that I sold. So it can go wrong, right? Especially when it comes to calls. And we'll talk about the risks as we go through these. So if you're long calls or puts, you have negative theta. So you're going to lose some money to time decay every day. That also includes weekends and holidays. If you are short calls or puts, you have positive theta, which means every day you're gaining some money due to time decay. So this is why when we buy contracts, You'll hear the leaders always talking about giving yourself the gift of time. Buy enough time, buy enough time, buy enough time. Why? Because if you look here, and this is sourced from the Options Industry Council, if you go out and you have enough time, you can see how there is the least amount of impact, going out further in time. So the further out you are in time, the less impact time decay will have on the price of your option. And as you get closer to expiry, especially within the last 30 days, that time decay becomes very, very quick. Okay, so think of it this way. Think of time decay in your option as if you have an ice cube in one hand and you have a hair dryer in the other, right? So every moment that passes, that ice cube is going to melt a little bit. But now imagine that the ice cube is the price of your contract and the hair dryer is basically just the expiration, right? So as you bring the two together, that ice cube is going to start melting faster and faster and faster until you reach expiry. So why is that important? Because if you don't plan out your trade properly in advance, especially if you're taking, weekly options out of the money, you need a spectacular move on the underlying in order for it to be profitable, okay? Most of the times when we hit those thou wows, they are on shorter dated, out of the money contracts. They have the highest potential return, but they also have the lowest probability of success. So always just, try and keep that in mind. Okay. Let's see, just move this here and I can maybe questions as well. So you want to be really careful. When it comes to trading options as compared to trading stock, remember that with stock, you can buy stock, you can go long stock, and you really only have to be right in terms of direction, right? Because it's either going to go up, down, or move sideways. If it moves sideways, okay, fine, you're not making money, but you're not losing money. If it goes up, you make money. It goes down, you lose money. Fine. But when it comes to options, you have an additional layer of complexity. Well, two additional layers of complexity, I should say. When it comes to options, you have to be right not only in terms of direction, but you also have to be right in terms of distance and time, which is why when options work, they work really well, right? On a daily basis, it seems that somebody in the pack is hitting 1,000% plus return. But keep in mind that those also have the lowest probability of success, right? So even if you hit 1 in 10, 1 in 7, you're still doing fairly well as long as you're managing your risk accordingly. So next we have gamma, okay? Gamma is the rate of change between the options delta and price. Simply put, it's how much delta will change for each dollar increase in the underlying. Gamma is something that people don't look at enough, in my opinion. And also keep in mind that let me cover Vega first, and then I'll explain how the pricing works and how a lot of these things work in our favor when they start to work. So gamma is the rate of change between delta and price. Vega is basically implied volatility, okay? It's also really, really, really misunderstood and overlooked. And this is how much the option will change in terms of volatility, how sensitive your options contract is based on volatility. So if it has a Vega of 0.10, it means that the options value is expected to change by 10 cents if IV changes by 1%, okay? So when you look at people who are buying options, trying to play earnings, and they're buying it right before the close thinking that, they're gonna hit a home run, the options have already got that uncertainty priced in, right? So when we look at the expected move, for example, that's what the market makers have already priced in on that, which is why the vast majority of traders who take options positions before earnings end up losing money because your stock could go up 5%, but because the implied volatility, it's what's called an IV crush, because that happens, you're going to end up actually losing money even though your stock has gone up. And if you've ever traded options through earnings, you know what I'm talking about, right? So just keep that in mind. I put an example here from when GME had that big run to show you the impact of implied volatility. So this is a screenshot that I actually took. So this was PayPal, was trading at 240.86, was up on the day. And so I just took that 240 call, right? So with 8 days to expiration, 1040 at the bid, 1070 at the ask. GME down $108 on the day at 238.56. Again, 8 days to expiration, was going for 96.15 at the bid and $100 at the ask. The difference was the implied volatility, right? This was like 738% or something ridiculous like that. So why is that important? With VIX, where it is right now, options are considered expensive, okay? If VIX gets, above like 35, I personally don't even buy calls or puts just because it's too expensive. So that's when I'll start doing spreads, which of course we're going to talk about tonight. So just keep that in mind, right? Because if you bought calls, for example, when IV was like 35, and then IV drops back down to 25, you're going to lose a huge portion of your options premium just to implied volatility. When implied volatility was super low, it didn't really matter that much, but keep in mind that right now IV is a bit higher, so just factor that into your trading, okay? You took that PayPal trade, nice. Yeah, I made some pretty good money off PayPal. And this is actually going to end in 10 minutes. Okay, we might need a new link then. So Legacy, if I can get you to work on that. Okay, so here's a couple of books. So Options is Strategic Investment, Options, Volatility, and Pricing. I'll post this in the main chat. And then Selling Premium, I told you, is very dangerous. So let's get into the actual meat and potatoes of why we're here tonight. So here's a question for you, okay? Right, so you find $100 on the ground, you get a $100 check from a dividend paying stock that you own. Your grandma sends you $100 for your birthday. You sold your old Pokemon cards for $100. You work and get $100. What's the difference? Right, when you go to the store and spend that $100, does it matter how you made it? It doesn't. Well, what's the point? There's a lot of professional traders out there who will trade just one setup, one stock. Some will only do covered calls. Some will only do put credit spreads, selling puts credit spreads. Some will only do debit spreads. All that matters is that you make money. And so once you find a strategy that you're comfortable with, stick to it. Don't worry about anything else, right? Here we trade the strat. We trade the strat really well, but there is more to the world of trading than simply, buying calls and puts on stock, right? There's a lot more that you can do. As you start to build your portfolio, you can start collecting dividends off the stocks. You can actually, basically options give you options, right? I know it sounds corny and, you hear it all the time, but options do actually give you a multitude of different ways, each with varying degrees of risk and profit potential. So you can use options to buy stock at a discount, which is what I'm going to show you here in a second, how to use options to generate income, how to protect an underlying position, and of course, to speculate, which is what we're already doing here. So the options basics, I've already covered that: delta, gamma, theta, and vega, right? So rate of change of the rate of change, time decay, implied volatility. So now, how do you buy a stock that you like. You can buy it at the market price, right? I want to buy SPY at 390. Okay, sure, I can go out and buy it. I can set a limit order. Say I want to buy it at 388.85. I set my limit order. If it goes down to that price, I can get exercised, or my transaction will get filled. Or you can sell a put and you can collect premium. So basically what ends up happening there is you get paid to buy the stocks that you want at the price that you want. And if it doesn't get to that price, you get to keep the premium. So imagine that you get paid to wait to buy the stock that you want at the price that you want to pay. So why is that important? Right? So for those of you that haven't seen this, this is Option Strat. Everybody should be on this 100% because this is probably the best site that I've ever come across when it comes to pricing options. TOS does a great job with the Analyze tab. If you don't have TOS, there's like Options Profit Calculator, there's Options Analysis. From all of the ones that I've seen over time, this is definitely the best one. And so what you can do here is you can actually go to Build, and under Strategies, you can go to your various strategies. So in this case, this would be what's called a cash secured put. So, we can look at, CLF. So let's say that you want to buy CLF at $19. Right? How much would you need? You need $1,900 because each options contract represents 100 shares. And so you would basically be giving somebody else the right to force you to buy 100 shares at $19 a share. And so if you go out to say July and you look at how much you can get right now, you can get $1.25. Which means that if CLF drops to $19 or lower, you will likely get exercised, which means you will buy it for $19, but you've also collected $1.25. So your actual cost would be what, $17.75? Can't go wrong with that. Right? And so the further out in time you go, the more money you're going to collect, right? So here, $1.93, go out to October, $267. And basically you're just going to wait. The further out you go, obviously the less money that you're going to collect, right? So you collect $27 and have to put up $1,500. So this is one of the situations where you're not, if you want to buy the stock, selling the put is probably the most effective way to do it if you want to pay a certain price, okay? But overall, it's not a very efficient way of using your capital, right? Because you could take that $27 and if you're good, you can turn that into, 10x, 15x, 20x. We've seen it happen. But if you want to buy the stock and you want to hold the stock, selling a put, a cash secured put, is the way to go. And so the margin or the collateral that you have to put up is basically the cost of basically your exercise price. So in this case, we'll use $15 times 100 shares. So let's say you want to buy, right? You want to buy 1,000 shares at $19. Well, you can pocket $1,250 up front to buy this at $19 a share. And then your cost would be, $17.75 after you've done that. So it's a great way to buy stock that you want at a discount. The next thing that we have, the next idea is, and I've already covered this here, is a covered call, okay? So you bought a stock that you wanted. Now, maybe your stock doesn't pay you a dividend, you can actually create your own dividend. So once you've sold your put to buy some stock that you want at the price that you want, you can turn around and create your own dividend or create a second dividend if your stock already pays one. So if it doesn't pay one, you're creating one. If it does pay one, you're creating a second, basically, stream of income from that stock. The most important thing to remember with covered calls is that you have to own 100 shares. And I'm going to say this, and then I'm going to say it again. Never, ever, 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 ever sell naked calls. Never, ever, ever sell naked calls. Okay. If you've been around for a while and you've heard of Raging Bull, well, one of their head guys there a few years ago, Jeff Bishop, thought that it was a smart idea to sell naked calls on Tilray around the time when Canada was about to legalize pot. And Tilray went from $150 to $300 in one day. I remember seeing his account, like when he used to stream it live, he was down well into the six figures overnight because of that. Okay, so never ever do that. Legacy, we're about to cut out here. So if you can create another
Yeah, I'm
link.
sorry about that,
Okay.
Strat. I accidentally logged in my personal account instead of the
Okay.
AlphaPack main
No problem.
account, so mine's not the paid version. So sorry about
Okay.
that, everybody.
No problem. So if you can create another one and
Yeah,
then
and I'll
we'll
make
just
that
post it.
one. I'll log in the other account too, so we won't be limited on time, and we'll
Sure.
just make a two-part version of the
Yep.
recording. All right,
No
guys.
problem. So I will stop the recording now, and then we'll continue in the new link.